Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
To weigh in on all of this, I'm pleased to say that we can catch up with the Disney CFO, Hugh Johnston. Hugh, it's wonderful to catch up with you, sir. As always, we've got to start with the price increases, first of all. It's on the minds of a lot of people, I can tell you, around this table as well, Hugh, so let's get into it. We've heard from a lot of companies that have talked about a loss of pricing power and sliding sales. What have you seen in the streaming business that gives you confidence that you can hike prices without that delivering increased churn?
Great. Well, good morning. Great to be with you all. Obviously, terrific quarter for us, and you all have mentioned the numbers a few times. The entertainment business is doing exceptionally well right now. We had the top movie in May, June, and July in the form of Planet of the Apes, Inside Out 2, and then now Deadpool. That's real value to the consumer. And as we think forward to what's going to be appearing on the streaming service, those three great motion pictures, the IP that we've produced ourselves, are going to be on the streaming service, as well as an enormous number of Emmy-nominated TV shows, including Abbott Elementary and The Bear, Only Murders in the Building, and of course Shogun, the huge hit. And when you deliver that much value to consumers, consumers are willing to pay a little bit more because, frankly, they're getting so much back in terms of entertainment.
Hugh, I've got to say, I'm with you. Shogun was awesome. I said that last time, just to endorse it once again. One of my favourites of the last 12 months. Clearly, the streaming business is doing well, which opens the door to hike prices. You can't say the same thing about the theme park business. Just what is going on there, Hugh?
Yeah, so one of the things to keep in mind is the theme parks business we have actually grew in the quarter. Revenue was up 2%. So we're not talking about a business that's going negative in terms of growth. Earnings were down a little bit because we had inflation and we're making some investments back in the business. What we see happening more than anything is the lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. But given the strength of the IP that we have in the park, given the quality of the experience, when the consumer is soft, it tends to hit us late. It hits us a little bit less, and we tend to recover early. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Hugh, one of the other complaints you commonly hear with the consumer is about bundles. Not that they're not good, but that there's just too many of them, and it's giving people fatigue. Do you think there needs to be some consolidation? Do you agree that there's just too many options right now?
Well, consumers do seem to appreciate having a limited number of bundles. Now, what we've tried to do with our own offering is offer the individual pieces, or if people want to get a discount by bundling, we're happy to do that. So that said, I think you do see a trend where there's probably going to be a few big competitors in the marketplace in streaming, as we see right now between Netflix, Amazon, and ourselves. And then there'll be some smaller competitors out there, and they'll have to decide how they're going to run their businesses.
Well, another huge draw of some of these is sports rights. And on this, Hugh, the NBA has had this very odd bidding war where you've come out unscathed, but Warner Bros. Loses out. You have Amazon.com, a new entrance in there. You have all these streamers coming in, trying to get their hands on live sports events. Do you think this is a healthy or unhealthy development for the industry?
You know, generally speaking, what you see is sort of the leagues are choosing to go with the big winners in all of this. So they've obviously been with us. ESPN in the third quarter had 49% market share of sports viewing, which is obviously a terrific number. So we have the A package with the NBA. We'll have the NBA finals for the next 12 years. Beyond that, I'd be speculating as to get into what their decision-making process was. But I think in general, they're quite pleased with what we've been able to do for them, and obviously we're happy with what they've been able to do for us. And you combine our NBA rights along with college football, along with the NFL, we've locked up sort of the most important sports to us in terms of being big and quite popular for an extended period of time. So we feel good about where we sit.
Hugh, I know there's a different price point, whether or not you want to be an individual that has to sit through advertisements. Are you seeing an uptick of political ads given the season we're in?
No, we really haven't seen much in that regard. So I can't certainly say that.
So you don't, do you expect that to happen? I mean, everyone says after Labor Day, this is when the campaigns are going to be in high gear up until November. Are you expecting an uptick of political ads on any of your streaming services?
Yeah, it's a great question. I couldn't tell you the answer to that one. So what I can tell you more broadly is the advertising market right now is incredibly healthy. We grew advertising as a company 8% in the quarter. Our upfronts for next year were quite successful. The upfronts were up 5%. And in addition to that, the streaming service saw a 20% increase in advertising, and ESPN saw a 17% increase. So generally speaking, the ad market is healthy. The biggest places that it's healthy are consumer and then technology.
Are you concerned that consumers right now potentially are going to shrug off the price increases? Because what we hear from a lot of companies is that we do see consumers trading down. Why do you think they're willing to pay for a higher price point?
Well, I think the biggest reason is it's always important to focus on this. The consumer receives value, and what they pay is price. And because we're delivering so much value, I mean, really an enormous amount of value in terms of the hits that I just mentioned. But then in addition to that, the combination of Disney Plus, Hulu, and then we're going to have an ESPN tile and ultimately ESPN flagship on our streaming service. That's a huge amount of value for consumers. And as they're allocating their entertainment dollars, I think they're going to view us as a great place to put them.
Hugh, you mentioned Hulu. Just how close are we to an agreement with Comcast? Where are we?
Yeah, we're in the middle of an arbitration right now, and as always, I'm not going to comment on arbitration outcomes and all of that. My guess is it's going to take a little while, but ultimately we'll get to a good place for the Walt Disney Company.
Got a decent idea of what the time frame is, Hugh, what a little while is?
Yeah, you're probably talking a matter of a few quarters would be my guess, but that's just a guess, so take it as that.
Well, just a guess as well on the theme parks as well. I just want to nail you down on that too. You talked about the middle of next year for the theme park business to be sort of bouncing back to where it was. The guidance has sort of shifted out, Hugh. What's the firm guidance coming from the company now? Because I remember it was going close to year end, we'd get that bounce. What happened?
Yeah, the consumer came in a little bit softer, and it was really the consumers that I mentioned earlier. The lower-income consumer is choosing to spend a little bit less, and again, the higher-income consumer is doing more overseas and outside the U.S. But again, I'll remind you, we're still growing in that business, so it's not a question of the business has gotten way off track. It's just a little bit softer than it was before because we're seeing toward the end of the quarter, we saw a few consumer trends emerge.
You have quite a unique vantage point, of course, Hugh. I used to talk to you when you were over at Pepsi during the pandemic. Coming out of the pandemic, you're now with Disney. So you have a very, very unique view of where the consumer is. What gives you the confidence just looking at your dashboard that it bounces back, that it comes back? Where does that come from?
More than anything, I do believe there's resilience in the U.S. economy. Obviously, markets are very sensitive right now and very fragile, as you all have been talking about in terms of news. But I think the U.S. economy is a little bit stronger than people are giving it credit for, and the consumer will come back as the economy continues to strengthen.
Interesting, Hugh. Appreciate your time. As always, sir. Hugh Johnston there, the Disney CFO. Darda of Roth MKM isn't waiting for that to draw conclusions. He says, bye-bye soft landing. It was nice knowing you. We may be finally entering a bad news is bad news environment with analysts' double-digit earnings expectations for the next 12 months looking increasingly out of sync with the evolution of the macroeconomy. Mike Darda joins us now for more. Now, Mike, before we move on, I just want to explain something to our audience. That quote, the timestamp on that quote is really important. That wasn't on Friday. That wasn't on Monday. It wasn't in the last 24 hours. That was last Tuesday on July 30th. It predates what we heard from the Fed, what we saw in payrolls. I can see you smiling. You're feeling good, and you should be. Mike, can you tell me what you saw that was guiding that view of things before we saw it for ourselves on Friday?
Yeah, thanks a lot, John. I really appreciate that. What we were seeing when we wrote that note was the Conference Board data for July. So this is survey-based data that essentially asks people about their labor market perceptions and their current circumstances. And what we saw from that data in both June and July is that the present situations index had tumbled about 20 index points from where it was 1 year earlier. Since the data goes back to 1980 or so, we haven't seen anything like that, a move down like that outside of actual recessions. And then equally importantly, there's a spread between those saying jobs are hard to get and jobs are plentiful that correlates very strongly with the unemployment rate, and that pushed to a new high for the year in July. And lo and behold, we got another pop in the unemployment rate. But those trends were underway even before the July jobs data. So I think we need to consider that, given that there's a debate about whether the data last Friday could be fluky. These trends have been underway; they're persisting, and our fear is that the soft landing could be slipping away.
Does that also imply that the Fed is just too far behind, that the data has already started to slip and they didn't go in July, therefore going in September, there's only so much they can do?
Yeah, I think that's exactly right. I mean, if we listen to Fed Chair Powell, what he was talking about at the last Fed press conference was this idea of a totality of the data. And if you look at a totality of the data, it really is a mixed picture, right? GDP and jobs look okay. And some of the other data that I spoke about, some of the survey-based measures and the move in the unemployment rate look more recessionary. And so this is why business cycles come to an end. When you're at an inflection point, it looks a little bit messy. It's not totally clear cut. So if policymakers are waiting for a completely obvious recession to slap them upside the head, then they're going to be way behind the curve.
Mike, you had a couple of trades. One was long duration. In equities, it was focused on defensives. We've had a big reset in markets since that call. Where are you now on where we should be in markets?
Yeah, I think probably investors should still stick with the defensive categories for now. We've been an advocate of the utility sector since last fall. Really got smashed hard last year with long-term interest rates rising so violently, up to 5% on the 10-year, and so a substantial chunk of that has been reversed. I think we're going to have to be a little bit more patient for some of the cyclicals. Even small caps, the valuations have come way down relative to the overall S&P 500. So I do think there are some increasingly attractive areas here that are cyclical, but the business cycle matters a lot. And so you don't want to be too early there. Typically, those areas are bottoming out as you move into like the middle part of a downturn. So I think for the cyclicals, more patience. I would not be chasing large cap growth concerns here. The valuations going into this correction were super high. We've been using the phrase rarely seen and never sustained. So the forward PE on the S&P 500 Infotech index was above 30 coming into this correction in mid-July. That's even above where we were in late 21, early 22 before a big downdraft in the equity market led by Infotech stocks. So my concern there is that the expectations are just way too high. I mean, overall earnings expectations growth for the S&P 500 now is 13% over the next year. That looks totally out of kilter with all the other indicators that we look at, and certainly a slowing economy, if not recession. So, I think we're probably going to be in a bit of a volatility storm here for a while. So defensive categories, I think, makes sense to stick with for now.
Mike, great call. It's great to catch up, sir. We've got to talk longer next time. Michael Darda of Roth MKM. Well, let's turn back to the United States. Nouriel Roubini of Roubini Macro Associates making some headlines, co-writing a paper saying the Treasury is manipulating debt issuance to boost the U.S. economy. Treasury Secretary Janet Yellen rejecting Roubini's argument, saying it, quote, suggests a strategy that is intended to ease financial conditions, and I can assure you 100% that there is no such strategy. Nouriel joins us now for more. Nouriel, wonderful to hear from you, sir. Let's just take it from the top. For the people that missed that and haven't read that paper that you co-authored and put out in the last couple of weeks. Activist Treasury issuance. Just take the opportunity to explain to our audience what you're talking about.
Well, Treasury usually in its debt management has what they call regular and predictable issuance. They say how many short-term bills as opposed to coupon clipping bonds they are going to issue. In the past, the rule has been that not more than 15 to 20% of the stock of that should be bills that are short-term, the rest of it being medium and long-term. But since last year, the issuance of short-term bills has been something like, at the margin, the flow of it, something like 60 to 70% of the issuance. So they've been issuing much less of the long-term bonds and more of the short-term bonds. That like a backdoor version of quantitative easing, because it reduces the supply of long-term bonds, it boosts the price and reduces the long-term interest rates on 10-year treasuries. We estimate that the amount of it has been such that is equivalent to a reduction of 25 basis points in 10-year treasuries or 100 basis points reduction of the Fed funds rate by the Fed. So the Fed is trying to tighten financial conditions to slow down the economy and inflation to achieve a soft landing, while Treasury has been trying to ease financial conditions by trying to boost the economy. So that's what's been happening.
Nouriel, there's a suggestion in the piece that this is a deliberate political project. What tells you that that's ultimately what they've been doing, and something, of course, that they deny?
Well, first of all, they do admit that what they're doing has an impact on financial condition. They cannot deny that. But then the question is about the motivation. Now, Treasury traditionally issues more of the short-term bills when there is a recession, a financial crisis, a liquidity shock, an episode like COVID, or other types of turmoil like a severe recession. That's normal and that happens. But we live in a time in which there is no financial crisis, growth is above potential, inflation is still above target, and financial conditions are normal. And until recently, effectively asset prices like the stock market were at all-time high. So the question is why they're doing it at this time. And my explanation was that last summer when 10-year Treasury went to 5% because suddenly the bond vigilantes globally woke up and realized that our deficits are large and unsustainable, Treasury got kind of nervous about it, and they decided to effectively a form of backdoor QE by buying more of the bills and issuing more of the bills and less of the long-term bonds. And that eased financial condition quite significantly.
The Treasury official that oversees debt issuance, Joshua Frost, had this to say. He said the autumn slowdown in added issuance of 10, 20, and 30-year securities amounted to roughly a 1% change. So how is that basically the Treasury knowingly trying to, what it feels like, manipulate the markets or make financial conditions easier if it's only a 1% change?
Well, what has happened is that the range of the stock of term bills was between 15 and 20. Right now it's significantly above 20. And the flow in the last few months has been something like 60 to 70% of the new issuance being bills. And on top of it now, the Treasury started even a forward guidance, Fed style. They've been saying that for the next few quarters, you can expect that the issuance of T-bills are going to be significant like in the last few months or quarters. That's a signal that this policy has gone in a very different direction from regular and predictable, very different from the norms that they choose themselves, about 15 to 20%, and is continuing to go in the same direction.
Well, Nouriel, the way that it's the same of norms, and you kind of hinted at this, that at every turning point, this is what the Treasury does. And not that it's a crisis, but the contention is that interest rates are coming down. That's why they issue more at a turning point, because essentially interest rates come down. You don't want to lock in long-term debt when it's going to come down later. So putting politics aside, if you thought interest rates were coming down, isn't this the right policy?
Well, first of all, the Treasury is never trading rates. That's not their jobs. Secondly, the yield curve until recently was significantly inverted. So by issuing bills, they're borrowing at much more expensive rates than you would otherwise. They're subject to refinancing risk and rollover risk. And we're seeing that there is episodes of market turmoil. And we know that bond yields are not going to go back to 0 or 1%. There are fundamental reasons: higher inflation, lower savings, more capex, why the equilibrium long-term real and nominal rate for long-term Treasury is probably closer to 5%, if not higher. So the right thing to do will be just to issue long-term debt rather than borrowing at much higher short-term debt. I don't believe. Right now there is an episode of risk-off. It's going to be probably temporary. Yields are slightly lower. But if you're looking at the medium term, given what's going to happen to the deficit, if Trump is elected, he's going to have tariffs, he's going to weaken the dollar, he's going to have permanent tax cuts that are not funded. All these things imply higher nominal and long-term interest rates. So this policy doesn't make sense, and Treasury is not supposed to trade rates. They're not speculators.
Ultimately, we're exploring two things here. One is consequences, outcomes. The other is motivation. It's much more difficult to decipher motivation. Let's talk about outcomes. Given the economic data of the last week or so, Nouriel, is there any evidence this is working?
Well, what's happening in the last week is that markets are getting nervous about a recession. But I would say the stock market has predicted 10 out of the last 3 recessions. Same thing with the bond market and the inverted yield curve. The markets have been mistaken even about the Fed. You know, at the beginning of the year, they expected 6 rate cuts when the Fed said 3. Then when the Fed went to 1, they expected 3. Now they expect that the Fed is going to do 4 of them, 25 basis points. So the markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
Elements of strength from Nouriel Roubini. So Nouriel, that tees up quite an obvious question. Let's talk about the market. You think it's a time perhaps where the economy is stronger than people think, which might come as a surprise to people watching this program, given how bearish everyone's become over the last few days. I think we all noticed last week an application for a new ETF. You're one of the 3 portfolio managers listed on the Atlas America Fund. Nouriel, with everything you've said in mind, what is going to go into that fund? What are you offering that perhaps we're missing?
Well, first of all, we're trying to hedge against tail risk like inflation, debasement of fiat currency, de-dollarization, global climate change, pandemic, protectionism, deglobalization, cyber warfare, social political instability, and so on and so on. When those risks occur, like they occur in the recent past, you have stagflationary shock, inflation is higher, growth is lower, and the traditional defensive asset that is long-duration Treasury does terrible. Look what happened in 22 when Treasury did worse than S&P. Look what happened last summer when yields went to 5% and Treasury lost 10%. So if inflation was even only 5%, bond yields will be something like 7 over the medium term. Today, they're less than 4. So we'd have another 40% loss on what is supposed to be the defensive asset, that is $20 trillion outstanding of long-term Treasury. So you need something that does well in bad times and also helps you to rebuild America. We need to have climate-resistant real estate, new communities, infrastructure, food security, reshore green metals, and rare earths, and so on. So what's going on in this new fund is several things that are hedging you against those risks. First of all, climate-resistant REITs. We have looked at all the REITs, so we see which ones are in the parts of North America that are going to be less subject to climate change. Secondly, these ETF allow you to invest into 15% of illiquid assets, new communities. Even Trump is talking about creating 10 new freedom cities. Biden and Harris want to invest into new infrastructure. We want to have food security. We want to reshore critical things. We need gold in this ETF to hedge against social, political, geopolitical, and financial risk. And if inflation is going to be higher, you want to stay away from long-term Treasury into stuff that's going to be having higher yield without having a price effect, short-term Treasury and tips. So they dynamically optimized combination of all these assets. They provide you a new, much more resilient defensive asset and one that invests actually in rebuilding America at the time when we need to do so.
That's the pitch. Fascinating stuff. Nouriel, when you're back in New York, which I think is next month, we're going to sit down and have a longer conversation about this. Appreciate your time this morning. Nouriel Roubini there, of Roubini Macro Associates. A lot to work through there. officials refusing to overreact to last week's payrolls data. Former New York Fed President Bill Dudley suggesting that patience might be misplaced, writing this: the Fed's wild ride has only just begun. A deteriorating labour market tends to be self-reinforcing. The longer the Fed waits, the greater the potential for damage. An immediate rate cut is in order, but that's very unlikely. Prepare for more volatility in stock and bond markets. Bill joins us now for more. Bill, let's start with the labour market, then we can get to the Fed's lack of response to it. What suggests to you that this is self-reinforcing? This is the beginning of something much worse?
Well, a couple things. Number one, we've seen a rise in unemployment claims. We've seen a drop in the hires rate. We've seen a drop in the quits rate. It looks to me like the labor market is cooling off quite significantly. We've also triggered the so-called SOM rule, where if the unemployment rate rises by more than 0.5% over a 12-month period, every time that's happened, we've ended up in recession. So there's a lot of risk out there to the downside in terms of the labor market. On the other side of the mandate, the inflation news has been very, very good recently. So it seems to me that the Fed needs to hold both sides of the mandate with equal weight right now, and that implies that monetary policy should be neutral, not restrictive. And we're a long way from neutral. I mean, people don't know exactly what a neutral monetary policy is precisely, but nobody thinks that 5.25% to 5.5% federal funds rate is consistent with neutral. Probably somewhere in the 3 to 4% range is where the Fed should be.
Bill, you've had an enormous influence on how people are thinking on Wall Street about what's ahead. So I want to ask you, if you think an immediate rate cut is not on the table, that they won't move into meeting, what would you recommend they should do in the next few weeks?
I think what they should do is change the messaging a little bit and make it very clear that they're now focused more on the labor side of the mandate, get the market attuned to the notion that if we get weak data over the next 6 weeks, that 50 basis points is highly likely at the September meeting. You can put 50 basis points firmly on the table if the data flow continue in the same direction.
And do you think they'd be willing to do that? This has been a very backward-looking Fed, and now they need to regain control of the narrative. Do you think that that by itself, at Jackson Hole, for example, would be enough to regain control of the narrative?
Well, it'll help a lot, because if people feel that the Fed's got it, financial conditions will become more accommodative, the stock market will recover, and they'll provide support. The problem here is when the labor market starts to deteriorate, confidence starts to decline. We saw that over the last couple of days. The big change in market sentiment, and when market sentiment deteriorates, that can be self-reinforcing. People start to pull back on hiring. People pull back on spending. Next thing you know, the unemployment rate hasn't gone up 0.5%; it's gone up a full percentage point or 2%. Percentage point, you're in a recession. Now, the good news here is that if we have economic weakness, the Fed has plenty of firepower. They're a long way from 0% short-term rates, so the Fed can respond pretty aggressively if needed. And I think my view is that the risk that they're going to need to respond aggressively has increased significantly in recent weeks.
Bill, I just want to put a fine point on that, because you did write about 2 weeks ago, before the Fed decision, before we got the jobs data, that not going in July would increase the risk of a recession. And all of that happened. So just how acute is the risk at this moment?
Well, I think that what's happened is there's quite a bit of stress in a couple areas of the economy. Number one, low-income households are really feeling it, both because they're tapped out the savings that was generated by the fiscal transfers during the pandemic, and two, they're the ones who pay the higher short-term interest rates in terms of credit card debt and auto loan debt. And number two, we're seeing softness in the housing sector, especially in multifamily construction. So you're seeing areas of weakness that are leading to softer labor market, and that's the softer labor market, though, is the key thing. If it frightens consumers, then you have weakness in consumption, and the thing becomes self-reinforcing.
I think the confusing thing for a lot of people, Bill, is for every weak point, there seems to be a strong point. For every issue at Airbnb, there is a Disney that can raise prices. There is an Uber that people are willing to buy. How do you distinguish between a lower-end consumer that's dropping off a cliff and one that has just gotten more picky with where it spends its money?
Well, it is difficult to sort out, and high-income consumers are doing pretty well. I mean, they've locked in low mortgage rates. They have been the beneficiaries of a very strong stock market. Even after the recent decline, the stock market is still up quite, over 10% this year. So the high-end consumer is feeling pretty good about things, but the low end is not. The other thing, of course, is also what's happening on the investment side. The Biden administration had a number of initiatives that boosted investment spending: infrastructure, CHIPS Act, climate, and the question is, what's the impetus from investment from those programs, has that peaked or not? And if that has peaked, that's another source of potential restraint in coming months.
Bill, it was great to catch up with you, sir. As always, appreciate the comments this morning. Bill Dudley there, the former New York Fed president.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.